Maybe it was time for us to get started.
Yep.
All right. Good evening, everyone. I appreciate you taking time out on such a beautiful day. It's awfully warm out, but hopefully you guys all stayed cool and had a good day. We are doing our Friends and Family webinar series. As you can see, tonight is all about what you need to know about Social Security. I believe this is our third Friends and Family webinar. These are being done because of you. We got an awful lot of requests from you that you asked if we could do a series of webinars that you could pass on to family and friends. And that's exactly why we're doing them. So like I said, believe this is the third one. We're excited to present to you tonight Social Security. I'm excited to have my colleague and longtime friend Sean Gibbons here tonight. Sean has been working with Coastal for 13, 14. What number are we on, Sean?
I think, 14 or 15 years.
It's been that great. It's going by that fast. See that? And Sean and I have known each other for over 30 years, and I'm excited to be able to work with him. So Sean tonight will be the one presenting. My name is Jim Horrocks. I'm the CEO of TimeScale Financial. So we get to use our new name today. For many of you, you've heard about our new name and all the things that are happening and the changes. So hopefully you received your nice tumblers out there. And if you have any questions about the name change, please let us know. But tonight is about Social Security. So Sean, if you could flip a couple slides for me, I appreciate it. So as I said, you know who the speakers are. Our purpose of tonight really is to give you a high level view of the ins and outs of Social Security, and hopefully what's a very easy and understandable way to digest the information. Social Security is a very specific topic. So if tonight, when you hear something and you want to know something more specific to you, please call us. We'll try to help you with whatever your question is, because a lot of times it really depends on your age, what you're trying to do, and other things to really help you make a decision. We are going to try to provide you some guidelines to consider when deciding on when to take your benefit, but you're going to get an awful lot of information tonight. We try to jam these things into about 15 or 20, 25 minutes sometimes, and then it's really all about you and questions. So Sean, hit it over the next one. We'll do the outline right now. We always want to start with what our empowered approach to financial planning is. It's good to do that so that we're all on the same page about how to look and view at this when you're talking about your financial plan and where you're trying to go. We're going to talk about really what Social Security is and understand what the benefits that they provide. And then ultimately, how does that Social Security, how should you be looking at Social Security when you're looking at your own goals and where you're trying to go inside of your own plan? And then, like I said, it's about questions. So I will be monitoring, looking at questions. Sean's going to take you through the presentation. And I think, Sean, we're ready to turn it right over unless I don't see any questions yet. So I'll try to field them. You'll see my hand go up. And if anyone needs anything, I will kind of pause it when we have a chance to do so. So take it away, Sean.
All right. Thanks, Jim. Appreciate the introduction. Again, wanted to thank everyone for taking time out of your schedule tonight to attend tonight's webinar. As Jim had mentioned, we're going to talk about, first and foremost, our empowered approach to financial planning and how Social Security fits into that plan. And really the whole purpose of our financial planning process is to make sure your goals are on track. And our process is really broken down into two phases. The first phase is to coordinate and consolidate your resources and make sure they're pointed in the right direction in order to achieve your goals. And there are three different segments in there. The first is spending, which is all about the budget, where you have income coming in, you have expenses going out. The second segment is savings, where we make sure you have an emergency fund, we're managing the debt properly, as well as short-term expenses, as well as saving for educational costs. And then finally, investing. This is where you're taking on risk with your money for longer-term goals, such as retirement, okay? So that's phase one. Phase two is about protecting and conserving everything we've done in phase one. And there are three segments here. The first is tax planning, where we want to minimize the tax bite from Uncle Sam. Risk management, which is just a fancy word for insurance. We want to make sure you have the proper health insurance, Medicare coverage, property and casualty, as well as life insurance coverage. And then finally, the last segment is estate planning, having a will, power of attorney, health proxy, as well as applicable trust, okay? So tonight we are going to obviously focus in on how does Social Security fit into your overall plan. But in the end, it's all about really measuring what matters to you and what is important to you. And that was kind of the reason for the rebranding of the name of our company, which is TimeScale, which is actually a real word which measures a unit of time. And it actually is used in the atomic clock. And it's all about precision and measuring what matters to you. So we're going to do a deeper dive into understanding Social Security and start off with the history of the program. It actually started in 1935 under FDR during the Great Depression, and it was basically created to provide retirement income for anyone who reached 65 years of age and older. And they added on to the plan with Medicare and disability insurance, but we're going to focus in on the retirement program tonight. So what is Social Security? It basically replaces a percentage of your pre-retirement income based on your lifetime earnings. Okay, so I'm sure most of you have seen the Social Security Administration statement. It's that green and white 3 or 4 page statement that kind of opens up. And this is something that you can not only find out what your benefit is, but it also lists every year of your earnings and for the last 35, 40, 50 years, depending upon how long you've worked. And that's what's used to calculate the benefit. So we always strongly suggest to make sure you look at the last page and make sure they're not missing any years of earnings, because that will impact your benefit. And if there is a 0 income year in there, you can always go to the Social Security Administration, provide a tax return or a W-2 statement to try to correct that. They send out the statement every 5 years now. They used to do it annually. And then when you hit 60 years old, they send it out on a calendar year basis. But you can go to the website that's listed here. You can request it to be sent to you. You can also create an account where they'll give you an estimated Social Security benefit as well. So how's Social Security calculated? So it's really based on your lifetime earnings. And there is a formula, but the main gist of it is they take they find the monthly average of your 35 highest earning years. Okay, so it doesn't have to be sequential. It doesn't have to be the last 35. It just takes the top 35 years, and then that's how the benefit is actually calculated. So that's why I mentioned, definitely take a look at your Social Security Administration statement, make sure those earnings are correct, because you could be shorting yourself, especially if there's $0 a year in there. I've seen that over time, and that can impact your benefit and reduce the average if you have a 0 earnings year in there, which might be due to incorrect reporting to the SSA. All right, what is your full retirement age? So this is a concept you really need to know in order to take full advantage and maximize your Social Security benefit. And what it means is that when you reach this full retirement age, based on the year you were born, you are entitled to basically 100% of your eligible benefit, okay? And it depends on what year you were born. So if you were born in 1943 to 1954, your full retirement age is basically 66 years old. And if you were born from 1955 to 1959, it is 66 years old and a certain number of months. And if you were born in 1960 and later, your full retirement age is 67 years old. And I'll kind of explain why is full retirement age a really important concept to know. All right. So it's important to know because the age that you elect to receive your retirement income from Social Security affects the amount. So you can start as early as 62 years old all the way up to 70 years old. Every year you wait and delay to take that benefit, it actually increases over time. So again, at your full retirement age, you get your full amount, the 100% benefit that you're owed. If you collect your benefit before your full retirement age, say at 62 or 63, you're going to get a reduced benefit. And then past your full retirement age, you're going to actually get a higher amount, okay? So definitely important to know what your full retirement age is. And what should you expect at your full retirement age? A low earner would be about 55% of your pre-retirement income. The average earner would be about 40% of your pre-retirement income, and a high earner would be about 1/3 of your pre-retirement income, just to give you an idea of what benefit to expect. An example would be, if you were born from 1943 to 54, at age 62 years old, you would receive 75% of your benefit. And if you collected at 66 years old, which would be your full retirement age, you receive 100% of the benefit. And then at age 70, you would receive 132% of the benefit. Okay? Another example of this is if you were born in 1960 or older, at age 62%, you get a little slightly less benefit of 70%. At age 67 years old, you get your full benefit of 100%. And then at age 70, you receive 124% of your benefit. So the big question that we always get asked, Sean, when should you take your benefit? Okay, really goes back to what your goals are, what your personal preferences, what are you trying to achieve? Okay, so the break-even point is about approximately 12 years old. So I'm going to kind of explain to that because there is a black and white number, but it really is dependent upon when you're going to die, which we obviously know is unknowable. But I'll give you an example. So if you start collecting your benefit at 62 years old versus 66 years old, the break-even point is approximately 74 years old, meaning if you died before 74 years old and you took it at 62 years old, then you made out. That was the right decision. If you live past 74 years old, you left some money on the table, okay? And then likewise, if you took it at 70 years old versus 66 years old, you waited to the end to take the maximum amount, the break-even point is approximately 82 years old. So again, you took it at 70. If you live past 82 years old, then you made the right decision. And if you died before then, if you took it at 70 years old and you lived past 82, that was the right decision. And if you took it before, you might have left some money on the table, okay? So I'll give you a couple examples. So say I was working with one gentleman, he was single, not married. He was 62 years old, hated his job, hated it. He's like, I loathe my job, okay? And he said that he was having some health issues, and there was actually not a lot of longevity in his family. His parents died in their 70s range. So he's like, I really want to take it. So what I did is I went through the Social Security, looked at his benefit, and I said, listen, if you took it at 62 years old, if you basically live past 74 years old, you'll be leaving some money on the table. However, based on his goal and his personal preferences and his personal situation, he took it at 62 years old based on all the information he provided. And he was fine with, hey, listen, if he lived past 74 years old, it was a miracle, and he wanted to enjoy retirement because he didn't like his job and wanted to spend the money when he was had some health and had some good years of retirement ahead of him. Okay. Another example is I was working with a couple, and there was a husband who loved his job and wanted to work into his early 70s. Okay. And he had enough income to live comfortably. He didn't rely on that Social Security income. His spouse wanted to retire, and she did end up retiring. And he decided to take it at 70 years old to take the max amount. Why? There was longevity in his family. His parents lived to their mid-90s. And he wanted to make sure that he had the maximum benefit for him and his spouse to make sure retirement was comfortable. So again, there's no right or wrong answer. There's just pros and cons. And our job as relationship managers is to educate you on how to maximize the benefit, the pros and cons to every decision, to come up with the best decision for you and your family.
Sean, we got a question came in already.
All right.
That if you don't need the money, or you're not necessarily needed to live on, why wouldn't everyone want to wait till 70?
Well, again, goes back to goals and your personal preferences. So I would say most of our clients, we recommend taking at full retirement age. And the reason is that you may want to spend a little bit more money in the front part of the retirement. And say you're 85, you're probably not going to be traveling as much or going out to eat maybe. Again, I don't want to stereotype anyone, but you're probably not doing as much at 85 versus 65 years old. So you could make the argument maybe taking at full retirement age at 66 years old makes the most sense because you have that extra money coming in on the front part of the retirement. And, if you live past, say, in your 80s, you understand that, but you can enjoy retirement with the extra money coming in on the front part.
Yeah, I've got someone who's picking on me right now, who's worked with me for several years and has said, I'm famous for telling people that yes, the math says to wait till 70, right? Because your benefit's going to grow and all that stuff. And we want to vote the positive. You're going to be here past 82 years old if that's the break even. But many times I do, and most people, that's what someone's picking on me right now. I always really do recommend people take it at the normal retirement age. And the reason for that is just as Sean explained. You're going to have the money now while you're younger and you have to do more things that Sean was just talking about. But, you know, if you make it past 82, which we hope you do, getting more money then doesn't necessarily, you know, it's not quite the same thing. Life changes when you get somewhere in your late 70s, early 80s. It's not that you're not happy, but you do go to eat at 4 o'clock because you're hungry, not because it's cheap. And you're probably going to split the meal with whoever you're with because you can't eat it all. That's just what we've seen over time. So we want to put the practicality around this and be more practical about the decision versus just always being about math. And I'd rather, you know, Sean said, we'd rather see you have the money. It's starting in 66 to enjoy it when you're younger and you know, maybe going to eat a little later than 4 o'clock. And then just enjoying the things more, because after 80, you may say, yes, I'm getting more money. I feel good about it, but you're not going to be spending. So that's, so someone who's picking on me, that's why I've been, I've always kind of stated it that way for most people I see.
Yeah, like I said, it's a personal decision, and that's why our job is to always explain the pros and cons, educate you, and then come up with the best decision for you and your family. But yeah, full retirement age makes the most sense for most people. But again, there's always exceptions to that rule.
Another quick question, and someone said, why not take the money at full retirement age and invest it?
It is something to consider. Again, it goes back to what your expenses are, how much investable assets you have, how much appetite of risk you have, what's your asset allocation. So there's a lot of questions to be answered on that. That's why we do the financial planning process on every meeting that we have, because it hits a lot of different points. So it is a possibility. Listen, I could make the math work in almost any scenario, but it goes back to what your goals are, what you're trying to achieve. To really truly answer that question. So what I would suggest is, I'm not trying to not answer the question, but for that person, we could run some scenarios to do that versus waiting versus taking it earlier. And then, you know, look at the plan and the different scenarios, and then have you come to the decision with our input and see what works best for you and your family.
You definitely can do that, you know, as you're explaining, Sean. You could take the money, try to invest it. I've actually had someone took Social Security early. They didn't need the money, but they set up a charity with it. You can do all those type of things, but you just want to be careful, which kind of leads us into the next conversation, which is you are taxed on Social Security. So you got to make sure it fits in, as Sean's saying, fits into your plan, and make sure that it's not messing up your taxes or anything else you're trying to do. So yes, you're right. This is your money. You just got to figure out how you take it, how it best fits for you, as you know, we keep saying, in your plan. But all of these things that you're suggesting are all possibilities for sure. No more questions, Sean, at least for right now.
Okay. So one of the things that a lot of people don't know is that if you are working, you can actually still receive benefits. Some people I've noticed, they think that you have to stop working to collect Social Security, and that's actually not true. You can work and still receive your benefit. However, there's some caveats that you should be aware of if you're working and collecting. So the first one is, if you're collecting your Social Security benefit under your full retirement age, there are income restrictions. So if you make over that almost $19,000 limit, your Social Security benefit gets decreased by 50%. Okay. So this is where, again, kind of going back to your question, when should you take it? Well, if you're working still and you like your job and you're making over that, you know, $19,000 threshold, and that we might want to delay taking the benefit because you have that income coming in, you're not going to get the full benefit because of the income restrictions. Okay. Another caveat is, the year you reach full retirement age, okay, they increase that limit. So say your full retirement age is 66 and 10 months. So when you reach 66 years old, and you're still working and you're collecting your Social Security benefit, you can make up to $50,520 and get your full benefit. But once you make over that threshold, then you lose a third of your Social Security benefit, okay? And then once you reach the month of your full retirement age or above, there's literally no limit, and you're entitled to your full benefit. So you make $1 million per year. Once you reach the month of your full retirement age, you'll receive the full benefit, and you're not penalized at all. Okay? Spousal benefits. So obviously, if you have a spouse, there's a couple of different things you should be aware of. If your spouse's own benefit is less than 50% of their spouse's benefit, then the spouse can choose the higher of the two amounts. And then the benefit of the amount can be reduced if the spouse, or will be reduced if the spouse is under the full retirement age. So something, again, to consider. You have all these little caveats when it comes to Social Security. That's why we always want to, dive in deep, and everyone's a little bit different. If you're a widow or widower, there are actually some benefits that you should be aware of. At full retirement age, 100% of the deceased worker's benefit is available. At age 60, you can receive 71.5% of the deceased spouse's benefit. And then you do have the option to collect benefits on one individual at age 60, then switch to a reduced or unreduced benefit on another individual at age 62 years old. And actually another benefit a lot of people don't know of is that if you are a widow or widower and you have minor children, they are entitled to typically the Social Security benefits of the deceased spouse as well while they're minors, okay? So again, another kind of layer to be aware of if you fit this description. Okay. Will my Social Security be taxed? So this is a big one that we spend a lot of time on.
Sean, can I hold up 1 second? I'm sorry, I was on mute. There was a question that came in. It was just more of a confirmation, I think. Someone was asking, so if they are, their spouse has a higher amount than they do when they hit full retirement age, they can take half of the spouse. I think we probably should put an example around that.
Yeah, once you run through that, Jim, because I know we were just talking about.
So basically what it means is so if you get to, if your spouse and yourself, so let's say you're both at the exact same age, and you have the exact same full retirement, it just makes it simple. And you guys walk up to Social Security and your spouse is going to get 3,000 of Social Security benefit and you're going to get 1,000. You have the choice to take either your 1,000 or half of your spouse. If your spouse is at 3,000, that means you could take 1,500. So unless you don't want the more money, you would obviously probably choose the 1,500 instead. That's what they're talking about. You have options of taking 50% or your own, whichever is higher. So in that example, the 1,500 or the 1,000 you could get on your own, you would take the 1,500 of your spouse. So that's what we're trying to get into there.
Yeah. And one of the things that we do offer, we have access to experts that work for the Social Security Administration for decades that can answer any specific questions that we may not be able to answer. And also, we also recommend before you take your full benefit, even if you think you know everything, we definitely advise to set up a call, or you can go online and schedule a meeting or go to a Social Security office and sit down with them. They're actually pretty helpful as far as trying to maximize the benefit and kind of going through all the different iterations as far as what's available. Okay. So, all right, so taxation when it comes to Social Security. So unfortunately, Social Security can be taxed, and it applies to those with a modified adjusted gross income. If you're filing single, if you make more than $25,000, it's taxed. Or if you're filing jointly, if you make more than $32,000, it's actually taxed. And up to 85% of the Social Security benefit is treated as ordinary income. So I would say the majority of the clients that we work with kind of fall into that category, but about half of the people who receive Social Security pay income tax on it. And then at the end of the year, the Social Security Administration sends out a 1099, no different than we do from Charles Schwab, which is our custodian. Okay, so taxation is a really, really big component on trying to, how does that fit into your overall plan? And we'll get into a little bit more detail on how that impacts you.
Sean, we had another question. We're not on the taxation parts. So we're close enough to where we just were, so I kind of want to try to answer it.
Yeah.
The question is, what about when you're divorced and we're married for 10 years or longer? As I understand it, I am eligible to collect my ex-husband's benefit. What percentage is that, and where does that leave him?
It does not impact your ex-spouse at all, okay? It's just the divorced spouse is entitled up to, I believe, 50% of the ex-spouse's benefit if it's higher than your own. So again, the caveat being you have to be married to that person for 10 years, but it absolutely does not impact the ex-spouse's benefit. They're going to get their full benefit. You're just entitled to that amount. And the reason why they did that is that, years ago, in the 60s and 70s, if you got divorced and you didn't work, then that one spouse ended up with no Social Security benefits, and they were doomed for a life of poverty during retirement, and they changed that to correct that problem.
Yeah, very important to understand. It does not affect the ex-husband at all, as Sean has said. A lot of people think, just like we were talking about, when you take half of your spouse's benefits, somehow it affects the spouse. It doesn't at all. The spouse is going to still get their $3,000. You'll get $1,500. Does not affect the other person whatsoever, and no difference in a divorce. Same story.
Right. So when you set up that appointment with the Social Security Administration, whether it's on the phone or in person, if you're not on speaking terms with your ex-spouse, if you still have their Social Security number, that's all you really need to know. You do not need to notify the ex-spouse at all. You just probably need their Social Security. Would make it easier to do the analysis, but definitely something to consider. Okay. So how do I apply for the retirement benefits? Like I mentioned before, you can go to the website, which is great, and apply online. You can call the Social Security to schedule an appointment. They'll actually even do it over the phone. So you schedule it. They have these robocalls that just call out. So if they say 2 p.m. on whatever, June 15th, they'll give you a call, you pick up, and then they'll walk through it. And then obviously you can go to your local Social Security office again, schedule an appointment. We recommend doing it just because there's so many caveats and so many wrinkles to your Social Security that you really want to maximize it as much as possible. And this is a great way to just reinforce what we're talking about tonight by just going to the horse's mouth and making sure everything is lined up to make sure you're maximizing the benefit. All right, so talked about Social Security in a little bit more detail. How does Social Security fit into your overall financial plan? Again, we talked about our empowered approach to financial planning. Again, the whole purpose of our process is to make sure your goals are on track. And when it comes to Social Security, how does it fit into this plan? It probably impacts spending, investing, and tax planning the most. So I'm going to spend a little more time on that. But in the end, again, the whole purpose of our process is really measuring what matters to you and making sure we're doing everything humanly possible to make sure your goals are on track. So when it comes to Social Security and how it fits into the plan, spending, knowing your budget is really important. So Social Security is a key part of this. You also want to obviously include pensions, the required minimum distribution, and also any money we're trying to take out of the investments or retirement accounts to bridge the gap to make up for any income above and beyond the different sources of income to make sure you live a comfortable retirement. Investing, you obviously want to make sure you align the time horizon with goals. We always want to match the portfolio risk with time horizons and goals, and then provide flexibility when it comes to retirement income. So, say your expenses are 100 grand, you get 50,000, say as an example, combined Social Security. Where's that other $50,000 coming from? And, can we generate enough income from the portfolio with the proper amount of risk in aligning the time horizon, your goals all together? So that definitely impacts the investing side of things when it comes to Social Security. And then finally, tax planning. Unfortunately, for most of you, Social Security is going to be taxable income. And then again, bridging the gap from your investments, we want to be mindful of taxes. And then you'll want to pay taxes in the most efficient way. So, one of the things that we always are mindful of, what's the tax distribution strategy during retirement? How much do you get from Social Security, pension, or other income sources? How much are we going to, your required minimum distribution? How much are we going to take out of your IRAs, 401ks versus Roth versus non-retirement accounts? Social Security kind of fits into that plan and trying to figure out the best way to take money out in the most tax efficient way. Okay, so we're going to open it up to more questions. There's a chat function, I should say. If you haven't found it, you can toggle usually on the bottom, and there's a little chat function. You can send the question to us because everyone's obviously muted besides Jim and I. And if you actually have questions, you can obviously contact me. This is my direct telephone number, my new updated email. Obviously, you can reach out to the relationship managers, but we're going to open it up to questions now so Jim and I can answer them for you.
We got questions for you already.
Okay.
So here we go. First one is, do you think Social Security will even be there in the future? That's usually the first question we get.
Yeah, that's the $64 million question. So every year they always come up and they always say, Social Security is going to run out of, 2029 or 2030. It changes every year and it always goes down. So the Social Security system is a pay-as-you-go system. So what does that mean? When you look at your pay stub, it actually, the FICA taxes, pay for a good portion of the Social Security. And what happens is obviously there's going to be more retirees than workers. However, the system doesn't go to zero. What might happen is for later generations or people who take money later on, potentially your benefit might get adjusted. However, I don't think they're not going to give you anything. And what's going to happen is they might have to cut defense or education or other programs. I don't think it's going to go to zero. Will it get adjusted? Potentially. Means testing is something you hear in Congress quite a bit. But if you're closer to retirement right now, I think we have pretty full confidence that you're going to get that full benefit. I think if you're going to retire 10, 15, 20 years from now, I'd expect probably a lower benefit. I mean, what's your thoughts, Jim, on that?
Yeah, this is my standard answer I give on this. First of all, we never want to predict what the government's going to do. I do not want to be in the business of doing that. That's dangerous business. But more importantly, generally what the government does, and you can think of it from a motivation standpoint, they're not going to do a lot to the group 55 years and older. And the reason for that is, believe it or not, you're the ones who vote the most. So they don't want to do anything negative in theory. I'm not saying this is definitely how they look at it, but this is a lot of times what you hear. They don't want to do anything to affect that group. So what they do is they'll leave that group alone, and then they'll make the lower group have to make changes and do things and so forth. It's kind of what you saw with the change in the full retirement age, right? It's kind of gotten collected. It's gone a little bit further out as the younger people. So, date of birth have now gone from 65 to 66, 67, and so forth. So there are a lot of challenges around Social Security. Does Social Security have some funding issues? Yes, but it does look like it's going to be okay. It just depends on how the government continues to spend it and use it. So I would just say to you that most likely I would expect it to be there. But again, I wouldn't want to make those promises then. Sean, we got another questions coming in. We got a couple of them coming in here. Someone asked, if I collect a pension from retirement from one, but have Social Security quarters from a second job, how does that work? Is it something that you need to deal directly with Social Security on? Actually, let me take this one, Sean, because I know who it's coming from, because they asked the question about pension. And I know where this pension is coming from. If it's private pension, doesn't matter. Social Security is not affected. But if you are, and I know this person did, if you worked in the public sector as for the state or an educator or something along those lines, and you have a state-funded pension or a federally funded pension, there's a formula that you cannot collect a big pension from the state or from the government and still collect Social Security. So basically, if you have a decent sized pension, most likely you're not going to get Social Security. It's a crazy formula. I'm not even going to try to put it up here, but I will tell you the best way to look at it is you will have to contact Social Security to try to figure whether or not you can receive it. Of course, if you know your pension benefit amount, that helps, and you speak to them. I will tell you, person who asked the question, I highly doubt you'll get anything, just because I know where your pension stands, and it's very tough to collect Social Security if you have a decent sized pension. But it's definitely worth asking a question. Social Security's gotten a lot better. That number that Sean had on the screen earlier, if you call them, it's not like the old days. You had to wait, hours and hours before they got on the phone with you. We've heard very positive things over the last several years about Social Security. So hopefully that answered your question. If we did not answer your question, please let us know. We will definitely do that. And we'll make a better effort. You're welcome. I got a nice comment. We had another question that came in before the presentation, and someone asked this, said, I'm retiring in 2020. I retired in 2020, I'm sorry. In my last year of wages, and that was my last year of wages, the maximum Social Security monthly payment would begin in January of 2022. When the person is 66 and 2 months. Will my estimated monthly payment be decreased because I did not pay any Social Security tax in 2021? That's one question. So I'll pause there. Like there's another question following that. So I'll give you that one.
Okay. I believe it could be slightly adjusted, potentially, but when did they get the estimate, Jim?
They received the estimate in 2020, they stopped working, no more wages. And they wanted to know that if they're not going to collect it till 2022, January of 2022, will they have a decrease?
They might, but it just depends on, again, they take the top 35 years and they take a monthly average to calculate that. So it really depends upon their work history. It's probably not going to be potentially material. Just 1 year would be my best guesstimate, but really a little tough to estimate what the actual change is. I think it'd be probably small. What's your thoughts, Jim?
Yeah, I agree with you, Sean. Look, most likely, if you've put in that many quarters and you're that far ahead and you miss 1 year in your 60s, it's going to affect it so marginally. It'll be so small. But again, this is a very specific formula of Social Security. You call this number, they'll help you out and give you the exact amount. Because again, the formula is very complex. But as Sean said, I think it'll be very de minimis at that point.
Yeah.
I've had
By the way, I do have a client that I've been on for years. She has a big fat 0 in her annual earnings, and it's definitely a mistake. And just do an average. You got a 0 in there, depending upon what your work history. It could actually skew it quite a bit. So you want to look at your statement and just peruse. It'll show you the 35, 40-year history, and just see if there's a year that jumps out at you that's incorrect. I mean, if you save your tax documents, you can correct it, but it is something just to be aware of, to take a look at when you're looking at the statement.
And the second half of that question was, my phone just went away. Okay. If I wait till age 70, then will the estimate monthly payment be decreased, as no Social Security taxes now have not been, I haven't paid any Social Security into Social Security for the past 4 years. So the answer is probably
your benefit will still increase because you're deferring it. Now it might be a little less on whatever the estimate is, but you're still going to get the annual increases. So generally speaking, from 62 to 66 years old every year, you get a 6% increase. And then from 66 or 67 years old, depending upon what your full retirement age is, you get the 8% annual increase. So you'll still get that increase. It just might be slightly a little different than the estimate that you have today, because it doesn't have that 1 year of income. But again, it's probably not going to be a material change.
I do want to mention one thing. This is a family and friends presentation, but I do notice there's a lot of people who do work with us today on the call. If you have any questions about Social Security, we help all the people that work with us to help you figure out what your best benefit is. So if these questions are driving you crazy or feel very overwhelming, call us directly. We have resources, people that used to work directly at the Social Security office, that we will get the exact answers for you, even run projections for you, do things for you to help you make the best decision for you on Social Security. So feel free, if you already work with us, contact your relationship manager and we'll help you with that and help you with these details. So like the person who's asking this question, we're not giving you the exact specific amounts, but we will certainly help you do that and come up with those answers for you. All right, we have another question that's come in. And the question is, what rate is Social Security taxed at?
It's taxed at your ordinary income. So it's particular to you. Now, going back, if I showed you the slide, it shows the taxation rate. It's basically 85%. Oh, sorry, I went the wrong way. 85% of the benefit is taxable income. All right, but it's taxed at the ordinary federal tax rate. So whatever your tax rate is, that's what it's going to be taxed at.
Exactly. And that's also why, so if you're making $50,000 and you collect 20,000 Social Security, it's just like you had another job and now you're making 70 and you'll be taxed as ordinary income. This really does tie in. It's really important, as Sean, if you go to the taxation one, as Sean was saying before, that tax planning around this is really important. Know what all your income is, know what bracket that's putting you in, because that is going to affect how you take distributions from IRAs and other things like that. For the people who do work with us, you hear us talk all the time about tax distribution strategies. So like, for example, if you're retired, and let's just say that you, as a joint couple, people filing jointly, you make $50,000 a year, I'm just using simple numbers, and that includes all your pension, Social Security, everything that you got. Well, you're already in a 12% tax bracket, but you don't jump out of that till 80,000. So you have 30,000 more you can pull out at an extremely low tax bracket of 12%. We may recommend that you pull out of your IRAs that 30, even if you're not using it, but to take it out and at a nice low tax bracket of 12%, we do that over time. We may save you an awful lot of money because the next tax bracket over 80 is 22%, a 10% increase. So if we do that over time and keep you taking money out of 12%, we can save 10% of your IRA. So that's why the tax part of this is really important. You got to know all the income that's coming in and how it affects you and what it does for your bracket, so that we can maybe pull out a lot of your IRA. People have 401ks and IRAs and all that fun stuff. Pull that out in an area that's going to be most effective for you.
Yeah. So one of the big changes that Congress just passed a year ago was how inherited IRAs are handled. So before, say you're married, and say both of you passed away, most of the folks we work with, the children get the inherited IRA from your retirement accounts. And before the change to the law from Congress last year, what you were able to do is your children were able to take out money over their lifetime, a little bit each and every year. So the tax hit was very, very small, and they allowed that account to grow over time. So say your child was, say 50 years old, and they were able to take a little bit over their lifetime over the next 50 years at a very small amount. Well, what they did is they changed it last year, where now your children have to take it out over a 10-year period after you both pass away. Okay. So basically the whole purpose was the federal government wants more tax dollars. So that is another thing to consider when we're doing the tax distribution strategy, is how inherited IRA assets are handled, how that impacts your estate plan, how you want to handle your legacy. And keep in mind, the Congress continually make these changes, and we're always up to speed on them to make sure your entire financial planning process that I'm showing you right now is on track to meet your goals.
And as Sean's saying, because the inherited IRAs now have to be taken out in 10 years, many times by the time we hope, because we're going to hope you're going to live a nice, long, happy time, by the time your kids inherit those IRAs, in general, they're in their highest tax brackets. So when they have to take the money out, they're paying at a very high tax bracket. That's why we like the tax distribution strategy of taking it out a little bit over time for you, at hopefully a lower tax bracket. But the other thing that's happening is we're reducing your IRAs and making them smaller. So we're transitioning from retirement accounts over to non-retirement accounts, which non-retirement accounts your kids will inherit. There's no tax, they just get the money, unless there's a death tax. But there's no income tax. They're not going to pull the money out and be taxed on it as income. So it's a really positive strategy to do. You really want to make sure you're paying attention to how you're taking distributions and what you're doing with them, and how you're affecting your family. First it's you, then the beneficiaries you want to leave things to. There's always changes of things that are happening, and that's why we always try to stay one step ahead of these changes to make sure that, again, you're reaching your goals and we're getting the biggest bang out of the bucks. One of them is taxes. Taxes, we want to try to pay Uncle Sam as efficiently as possible. That's what we try to do there. And these are the strategies that we try to do that definitely pertain to you and what you're trying to accomplish. Someone just asked, will this presentation be available? Yes, on every presentation that we do, we record them and then we send them out to you. Usually takes 3 or 4 days, because we try to, we come on very early and we try to get rid of the dead time before we start. So it takes us just a little time to do that. And then we send it back out to you as a recording. So yes, you will receive it. Just usually takes just a few days.
Yep. And feel free to forward to family and friends. As Jim mentioned, we're trying to help as many people as possible. Also, all these family and friends webinar, they're open to, again, family and friends, not just people who work with us. So just want to make sure that's clear, just because sometimes a lot of this information isn't available to a lot of folks, and don't have access to some of the resources that we have access to.
Another question just came in. They're saying, I'm not sure exactly how to ask the question, but I used to hear that if you were significantly younger than your spouse, that when your spouse reached their, I can't read the question, their full retirement age, can they start collecting the benefit when their spouses reach their full retirement age, even though they may be significant years younger.
Oh, that's,
I think they're scratching the surface of some of the old stuff that used to be there.
yeah, I don't know the answer to that question. I'll defer to you, Jim, on this
Yeah,
one.
the answer to that question is no, unfortunately. There used to, I think what you're getting at is there used to be a thing where, like you're describing, if your spouse reaches full retirement age and you're significantly younger, when you reached a certain point, you could start taking some of their benefits. And then when you reach your full retirement age, you could switch to whatever was higher for you. Those things don't exist anymore. Social Security, I was actually chuckling with Sean last week when we put this presentation together. It's a lot simpler than it used to be in the old days. They kind of stripped away a lot of these other type of benefits or opportunities to enhance your benefits with Social Security.
Yeah.
It's a little bit more stripped down now and much more kind of clean.
Yeah, so Jim, I think what they're talking about too, and correct me if I'm wrong, if you were born before January 1st, 1954, you're able to do that. However, you're born after it, you're no longer able to take advantage of that benefit. So I think that's what they were probably referring to, which was, just keep in mind, a lot of people took advantage of it, and that's why they changed the rule.
Yeah, they didn't like when too many people take too much advantage of the things they have out there. So, but that's
just
our job. We want to take advantage as best we can for you. So,
yeah.
All right. I don't see any other questions. So, Mike, I'm sorry. I just wanted to see if one was coming through. I don't see any other questions. So we hope you found this helpful this evening. We want to thank you so much for taking the time. Sean, you got to go over to disclosures. We always got to put our disclosures up on the screen. I just want to thank everybody again. Hopefully you're finding this helpful. It's fitting the purpose of you helping some friends and family and even yourself. And remember, if you're already working with us, feel free to contact us. We'll help you with all these questions one-on-one so you can do the best for you to help you reach your goals. That's what we're here to do. Otherwise, again, thank you for your time. Thank you, Sean, for going through this with us. And we'll look forward to seeing you soon. We are going to be taking the summer off because you guys are all very busy. So the next Friends and Family will be in the early fall, probably around September. So we'll be announcing that and letting you all know that. Any questions or anything you need, as Sean said, Sean, pull back up your information. You can contact Sean or your relationship manager, or feel free to just send in an email and we'll follow up with you immediately. But again, thank you so much. Thank you, Sean.
Great.
Hope everybody
Thanks,
has
guys.
a wonderful summer, and we'll look forward to seeing you all very soon. Hopefully, stay well.